Hello, welcome to IG's Trading the Markets. We're continuing with our outlook to 2024, and today we have a special guest. Tom Bailey, head of ETF Research at HANetf, joins me now to talk about two very key topics. One linked with defense, and of course, we've got these two wars still ongoing, and the second topic, uranium. Let's start with defense first. Of course, we've got Ukraine, Russia still in play. We've got Gaza also still in play. Neither going away anytime soon. Tell us a bit about your defense ETF first and where you think this will go in 2024.
Sure. So we have the Future of Defence UCITS ETF, its ticker being NATO or NATP for the sterling line. And the key thing about this ETF, as the ticker alludes to, it's a defence ETF, and it has the kind of traditional industrial manufacturers of weapons and armaments in there. It also has cybersecurity, because we increasingly see that as a core part of any national security defence. And you can see this coming out in places like Germany, US, UK, where there's a much higher focus on trying to protect against cyber attacks, which are increasingly part of the kind of geopolitical competition going on right now. In the early days of the war with Russia and Ukraine, obviously Russia launched massive cyber attacks. So we have that component too. So it's slightly different than maybe a traditional sector-based defense ETF. And at the same time, the ticker signifies something like the ETF, which is that the companies in there have to be domiciled within a NATO or a NATO ally country. And the point behind this is that we didn't want to offer a vehicle which could potentially provide exposure to geopolitically unstable or questionable countries, which would then obviously potentially damage the investors in the product.
Now, Tom, this NATO ETF was listed in July. How has it done since then, and which are the key sort of stars in the ETF, if you like?
Sure. So from listing in July, if you date the from the listing of the product itself, it's returned around 10%, but we saw a big jump in performance in October after the tragic attacks in Israel. And the way kind of we think about this is that you have strong performance from lots of these defense companies, particularly since the start of the Ukraine war. Their stock prices have risen strongly since then on anticipation of increased military spending, which we are seeing happen. And we're seeing this feed through to the companies themselves and record orders from companies like BAE Systems last year. But at the same time, what you see with defense stocks often is a kind of a flight to arms. So if investors are kind of aware of this concept of a flight to safety, so when there's a shock to the market, there's an economic shock, a macroeconomic shock, there's this kind of flight to safety where you see investors go and buy gold or US bonds as a kind of safe haven asset. What we do see at the same time, though, is when there's a geopolitical shock, which are becoming seemingly more frequent now, there's a flight to arms, and you see the price of these armaments companies spike up, and you see investors kind of try and buy those now as a hedge against these geopolitical shocks. And the whole idea behind the ETF was that we are potentially in a more geopolitically unstable world. We're not basing the ETF on any particular conflict. Obviously, in terms of the research around it and the movement from the stocks, it's about, say, the war in Ukraine is still a major factor of what we're looking at. But it's not an ETF about the war in Ukraine. It's about a potentially new era in geopolitics of a more geopolitically unstable world. And if that is the case, then it's an area investors will either want to exposure to for a long-term basis, or as a way to hedge against the kind of downsides to markets more broadly in the event of these geopolitical shocks we're seeing.
Where are you seeing most of the returns and the growth? Is it the cyber defense side? Is it in software, or is it more in military hardware? I used to cover the DSCI, which happens once every 2 years in London, and every year there's a different theme, if you like. So what are you seeing at the moment? Where are the growth areas?
Well, yeah, I mean, so if you look at, say, in terms of specifying one area right now, it's kind of because it's been a strong performance for both sides this year, given world events too unconnected. So with lots of the cyber companies, ultimately our tech companies, they're very sensitive to interest rates, and as we've seen the outlook from the Fed improve in terms of potentially keeping this pause going or cutting rates in the near term, then obviously that's helped performance of the cyber bucket. The earnings for increased demand for cyber security should obviously feed through to that too. And at the same time, given the continued and prolonged geopolitical instability around the world, therefore we also see strong performance on those sides. It's rare for both parts of the portfolio necessary to perform well together. If you often look at defence companies, they're industrials, they're cyclical, and if you look at cyber companies, they're growth stocks, highly sensitive to the outlook for rates, and they're not usually stocks that move in tandem often, but they have this year, which has obviously been positive for the performance of the ETF. But actually, when we first kind of looked at the mix of the two different types of stocks, we thought actually it was a good way to offer this kind of a diversified exposure. Now, obviously, it's worked differently this year. Hopefully, it doesn't lead to both of them having headwinds at the same time in the near term. But that's the kind of the balance we tried to strike in terms of different characteristics of stocks, so it's a better diversification tool.
Now, Tom, before the Russia's invasion of Ukraine, every major economy was kind of trying to diversify their energy as much as possible and gear up towards renewables. Of course, now that Russia and Ukraine have happened, there's this great talk, if you like, that uranium's hot again, uranium's popular again. Is this one of the reasons for the uranium-linked ETF?
Yeah, I mean, you can't. So obviously, the case for nuclear energy is what underpins the case for the uranium ETF in the way that the first point being, say, with climate change, we can't see a future forward for reaching any sort of net zero goal without nuclear energy providing a key role. But as you say, if you link it to defence, that's a second, and it's a very important aspect of this increased price for uranium. First being simply that if you want energy security at the same time, which obviously is back on the agenda, and again in a low carbon way, then nuclear energy is a vital way to achieve that. And we're seeing governments around the world pursue nuclear energy policy on that twin basis of climate change and energy security. And there's several kind of stats in which to kind of make that case for energy security with nuclear. So the first being, say, if you take a gas-fired power plant, about 70% of its total operating costs are the cost of the fuel. So therefore, if you're importing that fuel from elsewhere, if you're not lucky enough to produce it yourself, then that makes you incredibly vulnerable from these price hikes, which can come from the geopolitical shocks or disruptions to supply. If you look at a nuclear power plant, about 4 to 8% of its total operating costs are the fuel price. So it's much less vulnerable to these kind of international shocks to prices. Linking that back to defence, at the same time, we are seeing questions about supply based on geopolitical instability right now with uranium. So Niger, which last year produced about 5% of the world's uranium, recently had a coup. Much of that uranium went to France. The new government seems to be anti-French and isn't keen on continuing to export to France. And at the same time, if you look at, say, big producers like Kazakhstan, there's questions about the transportation of Kazakh-produced uranium in terms of added costs or reduced production, in terms of getting that to the West, given the geographic proximity to it. So there's all these other questions about the kind of geopolitical geopolitical effect of this on the price of uranium. But at the same time, given the small percentage of costs actually to it, if uranium prices do increase in conjunction with these kind of questions about supply disruption, it doesn't make nuclear power an unviable energy source. If the price of oil triples, doubles, it's immediately felt by consumers. The price of uranium triples, doubles, it's not felt by the end consumer, and therefore governments are much more kind of open to this idea of using nuclear power, which obviously requires increased uranium, which is in short supply right now.
Tom, correct me if I'm wrong, but I read somewhere that many of the mines are not back up and operational yet. So what does this mean for prices? Surely we're going to see price growth in terms of uranium prices just purely from a supply point of view.
Sure, yes. So this year we've hit $80 a pound of uranium. That's the highest it's been since before the Fukushima incident in Japan over a decade ago. And that reflects this lack of supply. So when the Fukushima incident happened, you had Japan temporarily shut down its nuclear power fleet. Germany committed itself to shutting it down completely, which they finally achieved. Japan's coming back online, but what that meant was that nuclear power in general fell out of favour. Lots of countries that were thinking of expanding or upgrading their fleets backed away. Then we saw these countries that started to remove themselves from the use of nuclear power, and the inventories then flooded the market. The sentiment around nuclear wasn't good, so these uranium miners didn't invest in production. Now we've seen this demand come back online and the case being made much stronger for the necessity of nuclear power. The supply is not able to keep up with this demand and projected demand. And so that's put immense pressure on the price of uranium. But at the same time, the price probably isn't where it needs to be to get lots of these smaller producers up and running again, in terms of it making it viable to either reopen mothballed sites or to start exploration on new sites. So, the elevated prices could remain and go higher for longer. Obviously, the longer they stay high, then the more incentivized these producers will be to expand production.
Finally, Tom, we still haven't, as a human race, managed to resolve the issue of nuclear waste. So how do we square that circle?
Sure. So, I mean, there's very advanced kind of initiatives. Say Sweden is a leader in this. 30% of Swedish electricity is produced by nuclear energy. In the 1970s, 80s, they built a big nuclear fleet, and that's why they have one of the lower carbon emissions per capita in Europe today. And they have the very advanced initiatives in terms of storing this waste. It's kind of often an overplayed risk and downside. There's waste from all these different products. Nuclear is the one which is monitored the most and has the most rules and restrictions around it. And obviously, no one wants nuclear waste leaks or anything like this. But the world, talking globally, the global nuclear industry is very strong on this and is very committed to ensuring that there's not these risks don't present themselves. It would destroy their industry if it did.
Right, thank you very much. That's Tom Bailey, head of ETF Research at HANetf, with his outlook to 2024 when it comes to the spot uranium miners ETF and also the very quirkily and aptly named NATO. This is the Future Defense ETF. This is IGTV. Thank you for watching.